Whole life insurance is one of the most misunderstood financial products, period. And I believe it comes from both sides. You have the agents on one side that are, trying to sell the product, so they're making it seem like it's something that it's not. And on the other side, you have people that just hate the product, that just have their own opinion and don't like it for whatever reasons. The challenge is, I think both sides overinflate what they're saying. They try to make it worse than what it actually is, or better than what it actually is. And that leaves you as the consumer confused. You say, well, both sides seem pretty educated. I don't even know who to believe. So I made this video because I want you to understand exactly how the product works, and then you can decide if it's something that makes sense for you or not. And I'm not sure how long this video is going to be, but I will leave timestamps in the description box below. That way you can go to a specific section if that's something you need to learn more about. So let's start off with life insurance. So what life insurance is a contract with the insurance carrier to where if you pay a premium and you were to die, they're going to pay out a certain amount of death benefit to your beneficiary of choice. So simple, straightforward. I live, I pay, I die, you pay, right? So that's exactly what life insurance is. Now there's two types. So there's term and then there's permanent. Now with term life insurance, you're going to have life insurance for a specific amount of time, whether it be 10 years, 20 years, or 30 years. Those are the three most common time frames when it comes to term insurance. Now you're going to pay that premium for that amount of time, and when that time is up, your insurance is over. Well, technically it's not that it's over, it's just the premium gets so high nobody even keeps it, so you might as well say it'll be over after that period of time, right? So it's no cash value involved, it's pure life insurance, and it's going to be the lowest premium. Premium just means payment, so it's going to be the lowest payment because you're just paying for pure insurance, and it's only going to last for a specific amount of time. Now, on the other hand, you have permanent insurance. So permanent insurance is going to last either to age 100, 120, or 121, and that depends on the company or carrier and the product. Now with permanent life insurance, you're going to pay that premium also, and that premium is going to cover the death benefit costs or the costs associated with the product. And also there's a second component called cash value. And that cash value is money that can grow for you that you can utilize while you are alive. So cost-wise, it's going to be a higher premium because, for one, the insurance isn't temporary, it's considered permanent, meaning the life insurance company knows they will have to pay out a death claim one day. So of course it's not going to be as cheap as a term insurance policy where there's a high chance you will outlive that term. And I'm not saying one is better than the other, they're just different products with different goals. Now underneath the category of permanent life insurance, one specific type is whole life, and that's the one we're going to focus on today. Now what I want to do is start off by clearing up some misconception. So one is that whole life is a great investment or whole life is a horrible investment. So neither one is true because whole life is not an investment, it is a life insurance product. Now, when it comes to someone saying whole life is a horrible investment, what they're doing is they're looking at the performance of whole life, meaning the amount of interest you can earn in the whole life product, and comparing it to what you can earn in the stock market. So I don't think that's a fair comparison because they're not the same product. One's not in the stock market, one is. So when you look at money, there's different asset classes. They're going to be ultra aggressive and there's going to be ultra conservative. So you'll have things like crypto, which is ultra aggressive, then obviously stocks, index funds, things like that. Then you have bonds, you have commodities like gold, you have high yield savings account, you have cash in the bank. So there's several different asset classes for your money. It's not fair to compare one asset class to the next because they have different goals. Meaning if somebody says, oh, I have all this money in gold, no one's going to come up to them and say, oh, you're dumb for having that money in gold. The S&P has returned 12%, 11%, 10% for the last 20, 30, 40 years. No one's going to say that because gold is a different asset class than investing directly inside the stock market. So I'm not for the theory of comparing the performance of a whole life product to the performance of the stock market because you're not locked into one. You can have a whole life product and have money inside the stock market. It doesn't have to be one or the other. You can have both. So the comparison where whole life is a great investment or whole life is a poor investment doesn't need to be had. Whole life is its own specific product and has its own specific goals. If I was going to classify it as something, I would classify whole life as a savings alternative. So versus having money in the bank, you have your money inside whole life because you're going to get a better performance. I'm not comparing the performance of a whole life product to the performance of Bitcoin or the S&P 500 or something like that. It just doesn't make sense at all. Now, the next phrase that I hear a lot that I want to address is that whole life is not a retirement plan. And yes, that is true. Whole life is not a retirement plan, but I believe people are saying that, guiding people and misdirecting people. So with whole life, there is cash value you can build inside the policy. Now, when it comes to your retirement year, there is money inside that policy that you can use to pay for your retirement. So when you say whole life isn't a retirement plan, yes, it's not a qualified retirement plan. It's not a 401k plan. It doesn't follow ERISA guidelines or anything like that. But look at it like this. If you have $500,000 in your cash value and you're getting ready to retire, guess what? You can use that cash value for retirement money. Just like if you have $500,000 in the bank, that's not a qualified retirement plan, but you can use that money for retirement. And I think that's all people care about is I want money I can use when I'm retired. And just as much as people are using whole life not being a qualified retirement plan is a bad thing, it can also be looked at as a good thing because since it's not following certain guidelines and qualifications under ERISA and things like that, you don't have to wait to a specific year or a specific age to start accessing that money 100% tax-free. Meaning if somebody wanted early retirement, they can actually use their cash value for early retirement. So it's all about who you're hearing the message from and how they're spinning it to benefit them and whatever their agenda is. But whole life is not a qualified retirement plan, but it is money you can use for retirement, just like you can use money inside of a brokerage account, just like you can use money inside your bank account. All someone cares about is when I retire, is there money I can use to live off of and pay my bills? Now, the next point I wanted to address is the saying that whole life takes years to build up any cash value. Now, that can be true. That's another one of those things that can be true, but it's not an absolute because it depends on your structure and the type of policy you have. Because essentially there's two different types of life insurance companies. One is called a stock company. So stock company, they're owned by shareholders. So just like if you bought Apple or Google, Amazon, people actually have stake inside that life insurance company. Now, when a company produces profits, it can reward a portion of those profits to its shareholders in the form of a dividend. So dividend is just taking a portion of the profit and paying it out to the shareholders of the company. Pretty basic, just like any other stock or whatever. They don't have to do it, but they can issue a dividend to the shareholders. Also want to point out that that dividend that pays out to the shareholders is a taxable dividend. So they will have to pay tax on the dividend received. Now, on the other side, you have mutual and mutual holding companies. So these life insurance companies are actually owned by policyholders versus the shareholders. So because the company is owned by policyholders, they have the chance to participate in the dividends themselves. So it's a little different, but it's still a portion of the profit that the company earned. Instead of being paid to stockholders, it is being paid to the policyholders. Now with those mutual holding companies, some of those companies will pay out a dividend to the policyholders. Now the policies that do allow the owner to receive dividends, those will be considered participating policies. Now on the other side, the ones that don't receive dividends are non-participating policies. And what are they participating in? They're either participating or not participating in the dividends. So that's the difference. So you hear participating company, that means they're participating in receiving the dividends or paying the dividends to the policy holders. So here's an example of a non-participating whole life insurance policy. These are also referred to as traditional whole life. So if you look at this, you can see the client is 30 years old. Their death benefit is $1.6 million and they're putting in $1,000 monthly. So here is the annual payment into the policy. The annual premium is 1,000 times 12,000. And here you see the cash value. So you see there's 0 year 1, 0 year 2. So yes, this policy, it does take time to build cash value. So you've put in $60,000 after year 5, and you've only have $29,000 in cash value. And your death benefit stays the same regardless of the cash value input. So this is traditional whole life. And if I fast forward, you can see year 16 is the break-even period. So that's where your cash value is more than your total contributions. And even with it being the break-even period, I know that's something that a lot of people look at. It only really matters if you're going to cancel the policy and walk away with the cash, because essentially you have a $1.6 million death benefit. And I don't know too many people that think they're going to get a $1.6 million death benefit for free. So they understand there's going to be costs baked into the policy. So even with that being said, even with the cost, you still break even at year 16. Now, another thing about whole life is that there's a guarantee. The guarantee is that that cash value is going to equal the death benefit at policy maturity. So no matter what, you've contributed this $12,000 a year, and it's guaranteed to grow. As you can see, year by year, it's going to continue to grow more and more. And at policy maturity, right here we have at age 120. Age 120 at policy maturity, you can see the cash value is equal to the death benefit. So that is the guarantee you are getting when you sign up with a whole life policy, whether it's traditional, participating, non-participating, it doesn't matter. And that's important to understand that that guarantee is intact. The insurance company is obligated to make sure your cash value equals your death benefit. Now, a second type is more of a paid up. So this is more of a paid up. So if you've heard of a 20 pay, that means you're going to pay into the policy for 20 years and then you're done. So this is comparing the two. So instead of the 12,000, because you're getting the same death benefit, but instead of 12,000 a year, almost 20,000 a year. So 19,946 going in a year. So you have cash value a little sooner. It doesn't look that great, but it's still sooner than over here where you're at zero. The break even for this policy is year 11, which is a lot sooner than the year 16 that we saw with the previous policy. So, and you can see the cash value is 113,000 versus 222,000 here. But even when you stop paying at year 20, it's still obligated that no matter what, as you move forward, when you reach the maturity of the policy, it's still going to equal $1.6 million. So whether it's an early pay, whether it's a full pay to pay age 100, because you can see this one paid to age 100 here, it doesn't matter. And all that means is once you've paid into this policy for 20 years, that means the payments are enough for that compounding effect to equal the death benefit at maturity. So that's a short pay, 20-year pay versus a traditional. They're both traditional, but one's a short pay, one's a pay to age 100. So that's the traditional policy, no dividends, just pure guarantees. So now we move over to a participating policy, meaning they're participating in the dividends, and it is structured for cash value. Versus the other one, you didn't have a lot of flexibility. This one's going to be structured more for cash value. So same 30-year-old, right? But you notice the death benefit is a lot smaller, right? Instead of 1.6 million, you have 231,000 in year one. We're putting the same 12,000 into the policy, 12,000 a year into the policy. So that's the same. Only thing we change is the structure and the death benefit amount. So here, we're looking at here, this is your cash value year one. So you put 12,000 in. Year one, the cash value is $10,638. This is with dividends. Without dividends would be the guarantee. So you see you have the guarantee here. That's without dividends. Non-guarantee means you're adding dividends. However, even though dividends are not guaranteed, most insurance companies that offer dividends have paid out dividends every year consistently for over 100 years. So even though it's a not guarantee, it has paid out. The reason it's more of a not guarantee because the amount, it changes from year to year of what they pay out. And I'll go over more detail about dividends and how it pays out and things like that. But guaranteed, you put in 12,000, a little more than 10,000 in your cash value in year one. That's a huge difference from the traditional policy we just looked at because of the structure. So it doesn't have to take years to build up any cash value. It could be cash value available right out the gate if you structure it right and you have the right type of policy, right? So I tell people your agent is the most important part of the process. So forget about the different companies. You want to have an agent that has access to multiple companies and knows how to structure a policy so you can get this done, right? So here, when we look at the non-guaranteed with the dividend, you can see the break-even period is year 5 versus year 16 in the traditional policy. Huge difference. So you've put in 60,000, which is just a 12,000 over 5 years. You put in 60,000, and your cash value is a little more than 60,000. And then you can see your death benefit, although it started off lower, is getting driven up every single year as the policy starts to accumulate, right? So with some additions, I'll go over the additions and how that's happening, but you see your death benefit is increasing every single year, and your cash value has broken even at year 5. Now, another thing to mention with this policy is the payments. So this contract premium, that's your payments into the policy. So you can see here at year 17 with the non-guarantee was the break-even period. So you can see you've put in $204,000 and the guaranteed cash value is $205,000. So this looks more like traditional policy, but not quite because you still have early cash value. But as far as the break-even period, it mimics the traditional policy. But you can see as you go on, right, the payment drops at age 61, right, because you have some additions that fall off due to the structure, and then the payment drops to $1,200 at age 67, and then you stop paying at age 76, no more payments going in, and then the policy still is obligated to continue to compound and grow because your cash value must still equal your death benefit at maturity. So this one matures at age 121. At that point, you're looking at $6.2 million in cash value compared to the 6.2 in death benefit. And on the guarantee side, 747,000 in cash value versus the 747,000 in guaranteed death benefit. So those obligations are still there. They're still guaranteed that the cash value will equal the death benefit, whether it's participating or not participating. But that shows you the difference between the different types of policies and how structure could come into play and make a huge difference. Okay, so now that you've seen the difference between a traditional non-participating and a participating policy based on the dividends, let's take a deep dive into what these dividends are. Because again, like I said before, dividends are not guaranteed, but they have been consistently paid out by companies for well over 100 years. So most companies do not miss their dividend payments. So your dividend is made up of three different parts. You have your expenses. So expenses are just operating the company. You know, you have your expenses to the company. So the better the expenses, the more the dividend can be. Also the mortality. Mortality is just the assumption on how many people the company think is going to die that year versus how many people actually do die that year. So the difference in mortality does affect the dividend rate. And the third is the actual investment account. So they have an investment account, and based on the performance of the investment account, that affects the cost of the dividend as well. So to recap, you have mortality, you have expenses, and you have the investment account. Those three categories make up your dividend. So your dividend payout is made up of those three categories combined. So remember when we looked at the participating policy example, there was the guaranteed column and there was the non-guaranteed column. So that guaranteed column is what the insurance company is guaranteeing they're going to give you. So you have to be very conservative to say they're going to guarantee you something until your age 120 or age 121. So with the non-guaranteed category, what they're doing is first looking at the mortality rate. They figure out, okay, what is the worst case scenario? So we understand a certain amount of people die every year, but what if it got really extreme? So they look at a really extreme case of if way more people died than expected per year, and they factor that in. Second thing, they look at the expenses. So let's say we did a horrible job at managing our expenses. How bad could it really get? And they plan for that. Third thing, they look at their expenses. Okay, what's a worst case scenario we see us getting in our investment portfolio? And their investment portfolio is mostly bonds. Bonds take up the majority of it. But they say, even with that being said, what's the worst case scenario? And they look at the worst case scenario. So they're giving the worst case scenario with mortality, worst case scenario with expenses, and worst case scenario with their investment account. So they look at the worst case scenario and they apply it to the policy, and that's where the guarantee column comes from. So pretty much it's there to protect you in case everything went wrong. Some people look at it as a bad thing. Some people look at it as a good thing, because if you're putting money in a company, you want that company to be prepared in case the worst case scenarios hit the fan. And that's exactly what they're doing when it comes to that guarantee column. So now when we move over to the non-guaranteed column, this is what really happens. So they plan for the worst case scenario when it comes to mortality, but not as many people died. Okay, so that means the cost is lower and they send that cost back to you. Then we look at expenses. They plan for the worst case scenario with the expenses, but they did a pretty good job managing their expenses. So there's extra money that gets sent back to you. And then they look at the investment portfolio, and their investment portfolio actually performed better than the guaranteed. They say, oh, there's extra money, and they send that money back to you. So some people look at it as a return of unused premium. Some people look at it as a return of overcharged premium, but either way, it comes back to you. Now, one good thing about it being looked at as overcharged premium is that because it's classified as premium that you've already put into the policy, when you receive it back, it's still going to be a tax-free dividend. So that's the difference between receiving dividends in a stock and receiving dividends in an insurance company, is because just as long as you're under cost basis, that return of profit can be classified as a return of premium, which classifies it as tax-free, because returning your own premium is tax-free because you've already paid taxes on that premium before you put it into the policy. So it's like the workaround. So it's all perspective of how you look at it, but dividends inside life insurance policies are tax-free. And that's how looking at it as a return of unused premium or overcharged premium can be a good thing, because you get those tax benefits. So I want to show you this example because I understand dividends can be hard to wrap your mind around, and I'm a visual person myself. So I want to give you guys these visuals so it helps you understand the process. So let's say you had two accounts. You have a spending account and you have a bill account. So that spending account, you're going to spend to zero every single month. You can do whatever you want with it. And your bill account is specifically for paying your bills. So the money has to be there to pay the bills, because you can't pay them from your spending account. So obviously you're gonna have to send money to your bill account every single month, so that when your bill comes due, there's money to pay that bill, obviously, right? So let's say you have $3,000 that comes in to your spending account from you being paid monthly. Immediately, you send over $300. Why do you send over $300? Because every month you understand your light bill, let's just say it's a light bill, your light bill is $50 per month. But even though your light bill is $50 per month, you do the math. You say, okay, I have a TV, I have a refrigerator, I have 3 rooms, I have 100-watt light bulbs. So you're looking at what's the most amount of energy I can use. If I left these lights on 24 hours a day, 7 days a week, I left the refrigerator door open, I left the TV on high, and I'm looking at what is the maximum the electric company can charge me per unit. And I say, worst case scenario, if I did all these things wrong, the worst my bill could ever be is $300 a month. So you send $300. So you're never worried that your bill is going to be higher than $300, because mathematically it's impossible for your bill to be $300, but you're planning for the worst case scenario. You're super conservative. So you send $300 over and it's sitting in your bill account. Then when your bill comes due, surprisingly, it's $50, right? It's normally $50, but you plan for the worst. So what happens is, because it's $50, that remaining $250 gets sent back to your spending account, and you can spend it on whatever you want. So it's kind of like how they do it when it comes to the guarantee and non-guarantee. So they're overcompensating for fees that may not happen, but it's possible that it could happen. And when those fees actually don't happen and they get the true numbers, whatever's left over, they send it back to you, and that's in the form of a dividend. So that's kind of like how I hope that visual helped you guys. So now that you have that example down packed and it kind of makes a little more sense, if it doesn't, maybe you go back and watch it. Now I want to show you an actual company paying out dividends. So this is a company, if I said the name, you'll be aware of what the company is. And they have a dividend interest rate of 5.15 for that year. That's what they quoted as far as what they're paying out, 5.15. So you'll see exactly how it's applied to the non-guaranteed and to the guaranteed side. So this will give you total clarity right here. So the first thing we're going to look at is the guaranteed column. So this is the policy value at the beginning of the year. So $90,772 at the beginning of the year. So then you have the annual premium. So the premium is the payment the actual client made into the policy, right? So that's the payment, bringing the new balance to $92,351. Pretty straightforward. Where they started, they added money, where it is now. Then we have the mortality and expense charges. So we're going to combine those two together. So the mortality is the amount of people that died. The expenses are running the operations of the company. So together, they're going to be almost $1,900, $1,893 in expenses they're going to charge your account on the guaranteed side. So after the charges, that brings the balance down to $90,458. Then there's a guaranteed interest rate. This is from their investment portfolio. They know their investment portfolio is going to spit out a specific guaranteed worst case scenario rate, and that's what they're giving you, $3,694 guaranteed. So the end of year policy value will be $94,152 on the guaranteed side. So that is what's guaranteed. Okay. So now we move over to the non-guaranteed side, and you can see how both of them are different and how it applies. So same thing. So top three are the same. So you have the starting value, their contributions the same, so the ending balance is the same. So now when they actually ran the numbers, their expenses and mortality charges were not $1,893. It actually came out to $477. Okay, that's a lot cheaper, okay? So Next, after you subtract that, that brings the balance to $91,874. Then as far as their investment portfolio, the investment portfolio performed well and did better than what the guarantee said it was going to do. So now we're looking at adding $4,731, bringing your non-guaranteed value to $96,605. That's the difference between the guaranteed side and the non-guaranteed side. So it's the assumption of worst case scenario versus what we actually did. So when we actually did those numbers, we're giving that money back to you. And obviously with the investments, we're giving you the additional growth of the investments. So the difference, so there's $1,416 coming back in the form of expenses and $1,037 coming to you in better accumulation from their investment portfolio, right? So your total dividend is $2,453. So your total dividend is not the same as your dividend rate. So your dividend rate is only showing the investment portfolio and what it's giving you into your account. So it's not the full dividend, it's the dividend rate. So it's important to understand that your dividend interest rate, or the DIV, is not the same as your total dividend. Your dividend interest rate is only talking about the investment portion, not accounting for the mortality and the expenses. So total dividend, $2,453. So that's hopefully that clears it up to show you what the difference is. So different companies have different ways of quoting their dividends. So try not to get caught up in who's paying out a certain dividend, because they have different ways of calculating their dividends. So I was just focused on it being a solid company. It is consistent with paying out a dividend, but more importantly, you have a strong agent that's going to guide you in the right direction, that's going to help you structure your policy to meet the needs that you're trying to accomplish. So now that we have a better understanding of what a dividend is and actually where it comes from, I want to talk about the different ways the dividend can be paid out. So for one, the dividend can be paid out in cash, meaning you could just receive a check for your dividend, which is great. And just as long as you're under your cost basis, it's going to be tax-free as a return of premium. So that's one way. So they cut you a check. Every time there's a dividend, you receive the check. You could do whatever you want with the check. Second thing you could do with your dividend is you can actually leave it parked with the insurance company in like an internal savings account, and it's going to spit out interest to you. Now, you have to understand that interest that it pays you is going to be taxable. So it's not like receiving the dividend in cash. If it's inside their interest-bearing account, when you earn that interest on that money will be taxable to you. So you could receive the full dividend in cash, or you could leave the dividend parked with an insurance company inside an interest-bearing account, and you receive the interest payments, but those interest payments to you will be taxable. Third thing you do is you can pay down your premium, meaning let's say your payment is $1,000 a month, but your dividend is $300 a month. You can actually have that dividend pay part of your premium. So out of pocket, you're only responsible for paying $700 a month. So you have your $700 payment plus the $300 coming from the dividend equals the full $1,000 of premium that's going into the policy. So you can pay down your payment, your premium payment, using your dividend as well. Another thing you can do with your dividend is you can actually pay down your loan. If you have an outstanding loan, you can have, assuming it's a $300 dividend that's paying out, you could have it pay off that loan on your behalf. So you continue making your normal payments as new premium, and then the dividend you receive actually pays down your policy loan, which is another great feature you could do with a dividend. So dividends have a lot of flexibility. And the last thing you could do with a dividend, and when I say last, doesn't mean it's guaranteed last. Different companies and products have different specifications of what you could do with a dividend. But the last one I'm going to cover is the one most commonly used. And that's using your dividend to buy paid up additions, or PUA, right? Paid up additions are just additional life insurance policies. So it's like you have money that pays out, and that money that pays out is going to buy paid up addition, which is small little life insurance policies that look like your current life insurance policy. So it might be kind of hard to wrap your mind around it, but I'll do my best to explain it to you. So let's say the dividend that pays out is $100, okay? So that $100 is going to buy a paid up edition. So all it is a single paid up policy, meaning it's a policy that's paid up, but it has the same rules. The cash value must equal the death benefit by age 121. So the unique thing about paid up edition is as you put that $100 in, about 95% of that goes towards cash value and 5% of that pays for the death benefit. And usually the death benefit is about 3 to 5 times of what you're putting in. So you have a small death benefit that's 3 to 5 times the contribution, but 95% of that money, usually it's about 95, it could be 90, but usually about 95% of what you're putting in is pure cash value. So this is one way to accelerate your cash value like nobody's business. So when we go back to the illustration of the participating policy, you can see this death benefit is getting higher and higher because that dividend that's paying out, you can see this dividend here, shows you the annual dividend is paying out, is buying more paid up edition, which increases the death benefit and increases the cash value. Because remember, about 95% of what that dividend payout is going to be pure cash inside of that cash value, but at the same time is buying 3 to 5 times that amount worth in life insurance death benefit. So the paid up edition is the way that this dividend is getting higher and higher every year, and this death benefit is getting driven up along with the net cash value growing as fast as it's growing. So it's like the accumulator when it comes to making your policy perform at optimal speed. So using a visual, this is kind of what it looks like. So as the money goes in, about 95% of it's going to go to the cash value, and then 5% of that is going to be buying the death benefit. And again, the death benefit is about 3 to 5 times of what's contributed. Now, the unique thing about paid up edition is that you have your regular life insurance policy that you started off with, and that policy is earning dividends. We already covered that. It's earning dividends. Now, when that dividends pays out, it buys this paid up edition insurance. Now, the unique thing about it is that now your original policy plus that additional paid up edition insurance are both earning dividends, right? So now the next year you have dividends coming from both places, and then that dividend payout buys more. So now you have all these dividends paying out, buying paid up additions, which are earning more dividends, and the compounding effect starts to kick in. So you can imagine, because now you have the compounding of these paid up additions, buying more paid up additions, buying more paid up additions, and that's how that cash value starts to compound and grow so fast. And this is why with all the things you could do with the dividend that's being paid out, buying more paid up edition is the most effective, and that's why it's the most commonly used, because it makes the most sense. It drives the cash value, it drives your death benefit, because remember, the higher your death benefit, the more guarantees on your cash value, because no matter what, the death benefit and cash value has to be equal. So as you get more death benefit, it makes your cash value perform better because it has to grow faster. So now that you understand how important paid up additions are, how do we blend them together to create a policy that's going to fit your needs, right? So there's 3 main parts to a policy. So you're going to have your base life insurance. So that's the base of everything. That's the actual insurance that you're going to have that's going to last to age 121. So that's your base. Then we understand we have the paid up edition where, 95% of that money is going to go towards cash value. So let's say you're putting in $1,000 a month. You say, okay, how am I going to break this up? So depending on carrier to carrier, everybody's different. So you could say, well, I'm going to have 10% of that go towards my base and 90% of that go towards my paid up edition. Because if I put 90% of that towards my paid up edition, that means 95% of that 90% is going to be pure cash value. And that's great. Sounds great. That can work. But you have to still follow guidelines. So there's guidelines in place that shows how much money you can put into a policy based on the death benefit size. So in a situation where you put in too much money and you've broken the guidelines of, the guidelines that are set, you can create a modified endowment contract, or a MEC, meaning now your policy has broken the guidelines and you lose all the tax favors of the policy. And that defeats the purpose of having the policy. So what we can do is we can add term life insurance to the policy, right? So you blend in the term policy, and the reason you blend in the term policy is because you increase the death benefit. So what whole life allows you to do is leverage the cost effectiveness of a term policy, but still be able to capitalize on the death benefit amount. Meaning you can add a term insurance policy to your policy, increase the death benefit for low costs, and that can help you stay within the guidelines of death benefit to premiums paid into the policy. Now, once you start blending these together, your base, your paid up addition, and the term policy, that's why I always stress that your agent is the most important part of the process, more important than what a dividend that paid out, because it's not always going to be the best fit to do a 10% base, 90% paid up addition with a term insurance blend. Is a term insurance 10 years, 20 years, 30 years? Should I do a base 20%, 80% paid up addition? So your agent's going to have to mix and match. There's no way I could just do a video to show you which one is best for every scenario. Because some scenarios, yes, the 10% base, 90% paid up addition is going to be best. But in other scenarios, it's not going to work out well, depending on what you're trying to accomplish. But blending those three together, staying within the IRS guidelines, is going to help you make your policy as efficient as possible and give you that early cash value that you desire. Now, the next area I want to go over is accessing money inside a whole life policy. Now, when you access money, you're actually leveraging against the money that's in your cash value, okay? So it's not the death benefit. So looking at this policy, I can't borrow against $500,000. I'm borrowing against this $137,000. So that's important to understand. You're leveraging against your cash value amount, not against your death benefit amount, right? And this particular policy loans are available after 30 days. So not all policies allow that, but in this one, you could take a policy loan 30 days against your cash value. Usually it's maybe about 90% of it, somewhere around there. Every carrier will be different. So when you borrow against a policy, for instance, when you borrow against this let's say you wanted $100,000. That $100,000, in most situations, I'm assuming you're going to want to take advantage of the tax efficiency of the policy. So when you borrow against that 137 and you take out 100,000, you're going to take it out in the form of a loan. Now, when you take the money out in the form of a loan, you're going to be charged an interest rate on that loan. So let's say you're being charged 5% on that loan, and that payment is going to the insurance company. Now, at the same time, you're still earning interest on your cash value, because since you got a loan directly from the insurance company, that means technically your money was not taken out of your cash value account. So that cash value will earn interest. Now, there's two different ways this can go, and this changes from company to company. So some companies are a direct recognition and some are a non-direct recognition. So direct recognition means they're recognizing you have a loan outstanding. Now, out of that $137,000, you've borrowed against $100,000. So they may recognize that $100,000 and say, well, we'll give you a full dividend on that remaining $37,000, but that other $100,000 is not going to get a dividend, or it's going to get a reduced dividend. So that's where they're recognizing that there is a loan outstanding, and that affects the amount of dividend that pays out. Doesn't mean it's good or bad. It just is what it is. Now, non-direct recognition, meaning you can have a loan out. In this scenario, you have a $100,000 loan against the policy. It does not recognize that loan, and it pays your dividend out in full on that $137,000 as if no loan exists, because it doesn't recognize your loan. So that's recognition versus non-recognition. And now when it comes to paying that loan back, there's different ways you can pay it back. You pay it back with premium. You can pay it back using your dividends, but it is not required to be paid back. Now, if it's not paid back, it's going to still accumulate the interest on the loan. In the event you pass away with an outstanding loan, it is deducted from the death benefit payout, and then the remaining pays out to your beneficiaries income tax free. So let's look at an example so I can explain what happens during the loan process. Now, let's say you passed away with $100,000 outstanding in a loan. So what happens is that $100,000 will be deducted from your death benefit, and then the remaining $566,000 would pay out to your beneficiary. Now, when you look at that, you may say, oh, well, they're keeping the cash value, but this cash value is already baked into the death benefit. Because if you look at it, you start off with $231,000 in death benefit, and if you added this $232,000, the death benefit would be close, but it wouldn't be as large as the 666,000 of what it is, right? Yes, you got to account for there is some paid up additions in there, but just understand that the cash value is baked into the death benefit. It's not looked at as two separate entities. So your death benefit payout will be a net of your outstanding loan. So if it's 100,000 loan, 100,000 would be removed. Remaining will pay out to your beneficiaries 100% income tax free. So I hope this video helped clear up some of the misconceptions and help gain some more insight on how the product actually works. Feel free to leave a comment in the section with questions if you have questions about something specifically, or if there's a certain area you want to go more in depth in, or worst case scenario, just leave a happy face in the comments if you found any value in this. That way YouTube will know this is a decent video and it'll get sent out to more people. But again, I appreciate you staying to the end. You take care, and I'll see you in the next video.